The Simple Path to Wealth, a very specific investment strategy. Okay, this is the 5th day of January of 2025, and this is video number 5. And in this video, we're going to talk about investing. Just to digress here a little bit, I think about how it was for me when I was first looking at investing in the stock market and in paper assets. It was confusing. I did not quite know where to start or what to do. And even when I did something, I didn't feel confident about what I was doing. And I know that for you, many of you may have a 401k or something like that at work. And maybe you remember being in that 401k meeting and having the different options of funds for you to invest in, and you were confused. You were not quite sure what to do. But here is the tough part of the rub, if you will. In the past, companies had pensions, and they kind of took care of this for you. And so you really didn't have to worry about this. But pensions are now a thing of the past. As I think about it, to use an analogy, it's kind of like a swimming pool. I used to like to go to the swimming pool when I was younger, but I was not a very good swimmer until my parents put us into swimming lessons. But before then, I was not a good swimmer. And let's say that you're not a good swimmer. You have the shallow end of the pool, and you have the deep end of the pool. Well, you not being a good swimmer, it's like somebody coming and just throwing you into the deep end of the pool and telling you, just swim. And that's kind of what's happening to us now. You have to be the pilot of your financial plane, and you don't have pilot training. And so it's tough. And I'm sorry that it's that way, but we don't have the luxury to be an ostrich and just put our head in the sand. You are the pilot of your financial plane. So we've got to figure this out. And so for me, having something like this Simple Path to Wealth simplifies this process for us and makes it easier to digest these concepts, to grasp these concepts of investing, okay? Now, I'm not a financial planner, so this is a disclaimer. I do not have the CFP, the Certified Financial Planner credentials behind my name. So I can't advise you on what to do with investing, but what I can do is allow you to be a fly on the wall of my critical thinking, and I can refer you to J.L. Collins' book, The Simple Path to Wealth, to help you get that strategy for investing, okay? Now, to get into the Simple Path of Wealth here, and why J.L. Collins wrote this book. J.L. Collins had a daughter, and he was very, very concerned about his daughter's future as far as investing and building wealth and having a good retirement and financial future. And so he would talk to her. He would, from her frame of reference, bug her all the time about personal finance and specifically investing. And he discloses that he kind of pushed her away by doing this. And he tells the story of one day his daughter telling him, "Dad, I know that this investing and personal finance stuff is important, but I don't want to think about it all the time. You know, I have a life." And I'm sure that that's some of what goes on in your psychology probably as you hear about personal finance and investing. You have a life. You have other things to do. You don't want to be thinking about personal finance and investing all the time. Now, of course, there's folks who are into that. The money guy calls them financial mutants. But, for many people, that's not what they're thinking about all the time. That's not what they want to push on. So what J.L. Collins did was he put together the information that finally ends up in the book, The Simple Path to Wealth, of exactly how he invests so his daughter could follow it step by step. So let's go ahead and get into J.L. Collins' recommendations. Okay, J.L. is very, very specific. What he recommends is Vanguard's Total Stock Market Index Fund. So that is his direct recommendation. And the ticker symbol of Vanguard's Total Stock Market Fund is VTSAX. Okay, so that's what he recommends, the Total Stock Market Index Fund. And all the Total Stock Market Index Fund is all of the companies in the U.S. stock market. What you're doing when you buy a Total Stock Market Index Fund is you're buying a little piece of ownership of all of the companies in the U.S. stock market. Now, we could get more specific, but that's basically what it is. What you're doing is buying a little piece of companies like Apple, Walmart, Tesla, and so on. You're buying a little piece of ownership of every single one of these companies in the whole stock market, okay? So you have broad diversity by doing that. So it's really simple. All you have to do is invest in that, according to J.L. Collins. And that keeps it very, very simple for you, because our psychology many times gets messed up about investing, because we're watching television and we're watching different things going on out there, and you turn on the television and something catastrophic is happening. Like recently, we had the pandemic. Stock market dropped. Well, what do we do when that happens? Many panic. They're like, I'm losing money here. They're looking at their balance in their 401k and it's dropped. And so what do? They retreat. They pull it out of the stock market, when exactly the opposite action is what they should be taking. Think about it. Let me just use a simple analogy for you. A lot of people, not everybody, but a lot of people have iPhones. And just to keep the math simple for me, let's say that iPhone costs $1,000, okay? So you're going to be an iPhone salesman in the future, okay? But right now you're buying iPhones so that you can sell them later. And I know that, they upgrade the iPhones all the time, but let's just say that the ones that you're buying now will be relevant in the future. And so you're buying them at $1,000 each, okay? And let's say something happens to where those iPhones are drop in price by 20%, okay? That's basically what happened in the stock market as well. But just go along with me on this analogy. They were $1,000, they dropped by 20%. That means that same iPhone is now $800, okay? Now think about it. If you're going to be selling iPhones in the future, is it better to buy them at $1,000 or $800, okay? Of course it's better to buy them at $800. And if you're really thinking about it, if you just looked around, even when they were $800, would anybody really stop using their phone? I doubt it. So that means that even when they're $800, they were worth probably still that $1,000, but the stock market just went, or the pricing of the iPhone just went down at that time. And so if you continue to buy those iPhones and accumulate them, when the price goes back up and even higher, then you benefit from that situation. So the whole point is, our psychology gets messed up. We can't keep that straight. And so rather than trying to time the market and become afraid when things go down in the market, a better plan is to just always be in the market. And again, J.L. Collins recommends the Total Stock Market Index Fund with Vanguard, okay? Now I'm going to throw in here another little concept besides just the Total Stock Market Index Fund that J.L. Collins talks about. He also recommends a mix of bonds in there depending on your risk tolerance, okay? Now, bonds are debt instruments. Now, government bonds or US bonds are considered to be almost 100% safe because so far anyway, the federal government has not failed to pay their debts. They've always paid their debts. So what JL Collins recommends is Vanguard's Total Bond Market Index Fund to mix in there depending on your risk tolerance, okay? If you know that within you feel really, off balance when the stock market goes down, like with the recent pandemic, if you were one of those that pulled money out of the stock market because you were afraid, you may want to add some bonds in there. Maybe you add a mix of 20% total bond market index fund. Again, JL Collins uses Vanguard's, so 20% total bond market fund, and go 80% total stock market index fund, which gives you a little bit of balance as the stock market goes up and down, okay? So that's it. It's that simple. Very, very simple. Total stock market index fund, where you're buying a total basket of funds. Just to get back, what is buying a total stock market index fund? You're just buying little pieces of ownership of different companies, all of the companies in the stock market, companies like Apple, Tesla, Walmart, McDonald's, and so on. You're buying that little piece of ownership of each one of those companies in the total stock market, the whole stock market. So you're broadly diversified. I'll throw in another little statistic here to kind of help you conceptualize this and think about it. There was a study that I read in the New York Times that looked at active managers. And there are funds that are actively managed. Something like a total stock market index fund is not actively managed. In other words, there's not a manager, there's not someone going in and picking those stocks. All it is the total stock market. Basically, the computer goes in there and makes sure that all of the companies within the stock market that reach the criterion to be in the total stock market are there. And then those companies are purchased. So a computer can take care of that, which means that the expense of running a total stock market index fund is less than hiring someone, a manager, to actually manage the funds. Well, what this article looked at was the performance of these managers compared to the index, okay? And the wild thing is what they found is that over a 10-year period, and I don't look at the 1, 2, 3-year period, I want a longer track record. So over a 10-year period, what they found is that for active managers, over a 10-year period, about 91% of them failed to beat the index. So think about this. You are just like me, just an investor investing in something like VTSAX, Vanguard's Total Stock Market Fund, and you're in a sense competing against these fund managers that have all of the best computers. They have education from places like MIT. They're going in and their full-time job is to look at computers and look at stocks and evaluate companies and all of this sort of thing, and they have all that expertise. And you're telling me over 10 years, if you just stay in the boring Vanguard Total Stock Market Index Fund, or you could use another company, but that's what JL Collins uses, you're going to beat those fund managers 91% of the time over 10 years. Now, if you compete against them over 20 years, it gets worse. It's almost 95% fail to beat the index, something like a boring Vanguard Total Stock Market Index Fund. It would be as if you were to play game after game of one-on-one with LeBron James, and 91% of the time, you beat him. That would be crazy. And that's what you're able to do by just investing in a total stock market index fund. So I believe this is a good recommendation for most people, for most individuals. Now, to talk about the bonds and a little bit of my plan on how to mix this together, okay? What I do is what J.L. Collins recommends. I invest in a total stock market index fund. Right now, 90% of what I invest is in a total stock market index fund. 10% of what I invest is in a total bond market index fund, okay? So my mix right now of my portfolio is a 90-10. I'm almost in my mid-50s now. So what I'm planning on doing is upping, at least right now, my bond exposure 1% annually over the next 10 years. So what I'm expecting right now, or what I'm projecting to do right now, is to increase my bond exposure, like I said, 1% each year. So over the next 10 years, it will go to 20% bonds in a total bond market index fund and 80% total stock market index fund. So an 80-20 fund mix. Just telling you that to give you my specific mix right now, or what I'm planning on doing also into the future. So take a look at these things. Look at this simple strategy. Because, you know, I think about the analogy. If someone was needing heart surgery and someone handed you a scalpel and said, you know, go over there and perform this heart surgery, you'd freak out because you don't know how to perform that heart surgery. And so that's what it's kind of like with them throwing us out here now without a pension or something else where someone else takes care of this for us. We've got to take care of it ourselves. We've got to pilot it ourselves. And J.L. Collins' Simple Path to Wealth is an easy way to get that confidence. All you need to do is look at a total stock market index fund and a bond mix depending on your risk tolerance. And you have a map to get in the game and to start investing without fear and without freaking out when the stock market goes up and down, because you don't want to do that. You just want to keep investing. A, B, B, always be buying. And so you just buy on a regular basis the total stock market index fund and some balance of bonds, depending on your risk tolerance. Again, if you freak out more when the stock market goes down, then you may have a little bit more bond allocation in your portfolio. Now, hopefully this helps to simplify the investing piece. I recommend reading J.L. Collins' Simple Path to Wealth to get the specifics and to get on the road to taking care of your future through investing in paper assets, utilizing index funds, and specifically J.L. Collins' recommendation of the total stock market index fund. Thanks for listening.